Okay, good morning, everybody, and welcome to today's webinar. My name is Phelim O'Neill from Channel Capital. For this webinar today, we will be providing less of an overview of Revolution as a business, what's been going on. We are going to do a little bit more focused on the state of the market, economic outlook, and how the team are thinking about managing the portfolio through more economic softness. I frequently get asked questions about what's happening in each sector that Revolution invest. So we thought today that would be a good area to focus on as well, give everyone a good sense of what's happening in each sector. So on the screen, in a couple of seconds, you'll see a disclaimer. So please familiarize yourself with this, even if you're already an investor with Revolution. It's quite important. We are open for questions throughout the webinar, so please submit them through the chat box down the bottom, and we'll get to the questions towards the end. So to talk more specifically today, we have presenting Bob Sahota and David Saija from Revolution. And I guess, Bob, over to you to start off with a business update.
Great, Phelim. Thank you, Phelim, for the introduction, and good morning, everybody. Welcome to the Revolution Asset Management webinar on private debt. Given the state of play of private debt in Australia and all of the recent press, it's quite timely to be talking about private debt and really how Revolution Asset Management has been able to navigate our journey thus far, but more importantly, we want to really be able to talk about how we're navigating possibly a more challenging macroeconomic backdrop going forward, and then also how we are different to many of our competitors who now we understand number and a couple of hundred managers in Australia that have sprung up in private debt over the last little while. So throughout the course of this webinar, we really want to unpack our approach to private debt and how we believe this is a more sustainable, more conservative, and one where we can really benefit from the experience and having worked through cycles in private debt to be able to look after investors' capital through the full cycle. But we are very pleased, if you look at this slide, to be able to confirm now we've crossed over $3 billion of committed capital. We have a very well-experienced and well-credentialed set of portfolio managers who've got a long track record in private debt. We're quite top-heavy in terms of experience, and many of us have worked together before in various organisations. The flagship fund is the Revolution Private Debt Fund number 2, which is an open-ended vehicle, which is now $2.5 billion Australian, with a yield to maturity of 10.3% before fees. It is well diversified now with 56 loans with an average credit rating of BB+. That alongside our separate accounts with larger institutional clients who ostensibly invest in the same mandate as the main master fund flagship, totals $575 million. We are supported, and this is one difference, supported by large institutional investors. So 2/3 of our $3 billion is actually from larger institutional clients. And then more recently, what's the fastest growing part is high net worth family offices, charities, foundations, who really value an exposure into private debt for all of the attributes that we will go through. We have the institutional consultant recommendations that we are very proud to say we're the preferred Australian private debt manager. And we're very ably assisted having a compact investment team with a very large infrastructure that Channel Capital provides us, which has been a relationship and a partnership that we've had since inception. A couple of recent developments from our side. In response to a lot of feedback from clients, we've moved from quarterly distributions, which we formerly had, to monthly distributions as of last month. This has been met with quite a lot of excitement by the investor base for clients who are looking for effectively an income replacement. So going from quarterly to monthly has been well received. I will point out though, if that's not required from any particular investor, all you have to do is check a box and have any of your distributions basically reinvest in further units in the fund. But it's nice to have that option to get monthly income. Earlier this year, we established a New Zealand PI vehicle, and that is a vehicle that we've been thinking about for quite some time, having been active in New Zealand really from the inception of the firm 6.5 years ago. And really in prior roles, we've been investing into New Zealand for a very long time. We gauged interest of whether we would have much traction in a New Zealand PI vehicle should we set one up. We're very proud to say we've now committed to that, and we now have in excess of $30 million that has actually been allocated into that new vehicle. That is again open for business. It invests in a very tax-effective way in effectively the same master fund vehicle that we offer our Australian clients in a PI structure. And then thirdly, the most recent development is the growth that we're experiencing. So our monthly inflows into our flagship fund used to be regularly $15 to $30 million Aussie per month. More recently, given the performance and the attraction and the diversity, the non-correlated nature of the income that we can produce has now resulted in growth, which is now $40 to $60 million per month. And we are very proud to say that we've been able to deploy that as we go along, given our size and scale. This is a slide that hopefully would be familiar to many of you. It is one we use to describe the landscape of what is the definition of private debt. And this is where I believe the confusion really stems from. The definition of private debt will depend on any particular manager operating in this space. And so each of those strategies are quite unique. I won't go through all of these, but I would say we are going to go through the 3 key sectors that we focus on at Revolution Asset Management. It's a strategy that I initially established in Challenger in February of 2005. So it's actually had the benefit of being able to be tested through the global financial crisis. It is really centering on a relative value approach in constructing portfolios across stabilized commercial real estate debt. So we don't do any construction and development loans, which really sets us apart to many of our peers. Then we provide senior secured finance in leveraged buyout deals. So where private equity goes out and acquires very large scale companies that occupy a very good market share, we, alongside other lenders, in some cases are leading the club of lenders that provide the senior secured debt pursuant to those acquisitions, is another key area of focus. And then asset-backed securities. So most of our exposure in asset-backed securities is on the private side, which is now enjoying quite a significant illiquidity premium versus a very, very active public market. And so that's another area that we are one of the leaders in the private space in asset-backed securities. Across these 3 sleeves, our target investment objective is cash rate plus 4 to 5% net of fees. And we're proud to say we're performing ahead of that at the moment. This is a slide that's also been well received over time, which really shows the fact that everything we do is floating rate. And so in the middle bar, in the middle line, you can see the light blue line is the credit margin across the loans through time that we invest in for the fund, for our Revolution Private Debt Fund number 2. It's been remarkably stable at high 5s to just touching 6% through time, going right back since the inception of the fund. We have been really the beneficiaries, or our investors have been the beneficiaries of the well-telegraphed rises in interest rates by the RBA. So as we've developed through time, the rates have gone up, so the heavy lifting really for the yield of the portfolio has been done by the Reserve Bank. So you can see there with a short lag, the top line, which is the dark blue line, has increased with the cash rate by virtue of the fact that everything you do is floating rate, to the point now our gross return before fees is now in excess of 10%, which is very, very attractive to all the way from institutional investors to high net worth family offices, endowments, charities, foundations. So we believe this is a very attractive risk-adjusted return for a well-constructed conservative portfolio of loan assets which are all secured. Just a quick word on the macroeconomic environment. We, being fixed income or debt investors, are constantly looking at what can go wrong. So we're unlike all the equity guys that you might hear shouting from the rooftops about how markets are going to remain up and all these stocks are going to keep going up. We are very much in an asset class where we only receive our interest when it's due and only really receive the money back at the end of a loan term. So we are really always looking for what happens to a particular loan should there be a downturn or a protracted recession. Are these companies or pools of assets able to adequately address that sort of macroeconomic picture? So as incomes decrease, the economy slows, discretionary spending, which is, this cost of living pressure that we're constantly reading about, will ultimately lead to companies having less of a positive view on the future, and therefore unemployment increases through that cycle. How do we respond? We respond by having an investment philosophy right from the beginning of our inception 6.5 years ago of only targeting non-cyclical companies, ones that occupy leading market shares, and ones that have got low to moderate leverage levels. So these are kind of companies that can withstand input price shocks and inflation. And then we also, on the asset-backed security side, are going to be have targeted well-established, profitable non-bank issuers who have got a focus on prime borrowers, i.e. high credit score borrowers, with a history of repeat capital market issuance. This is the kind of way that we really fend off any downturn impacting the creditworthiness of the loans that we've made in that portfolio. I might now turn to my colleague David Saija, who's going to go through the state of play in the three particular market segments that Revolution focuses on, to give everybody a current up-to-date view of how we're seeing those particular markets.
Thanks, Bob. As was mentioned earlier, there's been quite a bit written about the private debt market in the media. With many new managers coming to market. The last number we saw was in excess of 200 managers now exist in Australia in the private debt space. Our understanding is most of those new managers are operating in the real estate debt development construction part of the market. But let's take a bit of a dive into each of the three key segments of the portfolio and take a look at what we're seeing there. So starting off with leveraged buyout loans, what we're really seeing here is a bifurcated market. So the market is basically split in two, where you've got one is kind of the higher risk, higher margin, high leverage deals. These are deals that have typically been targeted by kind of offshore managers that have come into the country, where they need that higher return hurdle. Here we're seeing things like no covenants. You're seeing unitranche deals, or you're seeing cov-lite unitranche, putting the two together. You're seeing weak terms and conditions, and you're also seeing the term payment in kind, or PIK, re-emerge, which is basically when interest is capitalized instead of being cash paid, which we're not a fan of. We don't like that at all. All our loans are cash pay. On the other side of that, you've got the lower margin, lower risk deals that have lower leverage, and these are more like the old school bank type deals. Where you've got a covenant, at least a covenant in place, you've got moderate leverage levels, and we here target, non-cyclical companies that Bob mentioned earlier, but operate in a very solid industry with strong market share. Now, in this particular case here, we are giving, and this is a section that we focus on, we are giving up some margin, but this is because these are lower risk transactions, and we feel at this point in the cycle, this is a prudent way to manage risk. In terms of deal flow, 2023 was a rather quiet year for M&A activity. We are seeing that pick up this year. Last quarter was quite strong, so it's kind of patchy at the moment, but we are seeing improvements there, which is a positive sign. I think it's largely been driven by One is kind of the stability in monetary policy, which is allowing private equity firms, one, to value assets appropriately, and two, it's giving them, the PE sponsors, confidence in what capital structure they can actually deploy when acquiring these assets. In terms of pricing, we're seeing that hold fairly firm. Our kind of deals, or bank style deals, are holding around the 400 to 450 basis point range, which is what we're targeting, which works really well. But what's a key point here is that Revolution scale. So as we've grown over the years, it's allowing us to drive direct deals where we're setting covenants, we're setting all the key terms and conditions. And again, this is where we're targeting, low to moderate leverage, low margin, low risk deals and companies with strong terms and conditions. And we're typically seeing less competition for these types of deals.
I might add there, the international guys are significantly competitive in terms of the size of capital they're bringing. But as Dave mentioned, they are targeting much higher risk and much higher return. The reason why that is because they're competing with global deals. And in Australia, they've got hedging costs to contend with, and also the fact that these are less liquid typically than what they find in their own home markets. So in that space of higher risk, higher return, and Dave mentioned payment in kind is starting to enter the scene as there's more competition for that higher risk return deals. The payment in kind is really something that we wouldn't entertain because we can't actually distribute capitalized interest or payment in kind. We really don't see that as being competition for what we do. As I mentioned, our return hurdles are the RBA cash rate plus 4 to 5%. And in that particular postcode of return, we believe we are one of the largest scale providers of capital in that space, where we can bring north of $100 million buy and hold appetite to those deals, which Dave is going to go through, a great example more recently of something that we've just done that really brings this whole thematic out to illustrate what we're saying.
So this is a recent transaction that we structured and arranged. This means that we had key input and we were key drivers in the terms and conditions of the loan. In this particular case, we did $100 million of the total facilities, and these generate a yield. This generates a yield of around 10% for the portfolio. Now, being structured and arranged of this transaction, we got strong upfront fees, which again, as a reminder to everybody, these get put into the fund to the benefit of all investors. So all the unit holders in the fund got to benefit from those upfront fees that we generated, which will typically get paid to the syndicating or originating bank. So that's a great outcome. This particular company is a market leader in the sauces and condiment space. Now, when we first heard about this transaction, we kind of felt we're wasting our time in attending the meeting to hear about it. But I thought, look, let's go along, let's hear what the deal is and get a bit more insights. After 2 hours of sitting with the sponsor in this transaction, we walked out of a meeting absolutely loving the company, loving the space they play in, and really understand why they're so strong in their particular market. Now, they've got a very diversified channel mix. So they sell through restaurants, through cafes, through kind of the larger fast food chains, right down to kind of the smaller end of a retail market. You can see there on the bottom right-hand side, you've got a bit of a kind of summary there of some of the key customers, including Guzman y Gomez, Domino's Pizza, Coles, Woolies, and some of the kind of larger wholesale distributors like PFD and Bidfood. The industry's been remarkably stable over a period of time. Now, one of the key drivers of this is, there's a couple of things. One is where they sit in the market in terms of they can do mid-sized runs for customers where the larger guys won't do because it's uneconomic and the smaller players don't have the ability to do that. And secondly is the sauce and condiment that they produce are only a very small portion of the total cost of the food item being produced in the end. But it is a key driver of the flavor profile of what the end customer is actually selling. So for a very small cost, it's really driving a flavor of their product. So that's also created that extra stability. And also just how they're diversified throughout the whole channel mix. As customers trade down, this particular company operates in all facets of the market. So, if you see demand drop in one, it'll pick up in the other category. So we've seen that historically, which is a really good sign to see. Their track record has been very robust, very strong financial profile with organic volume and price growth. And importantly, a key area that we focus on when we look at these companies is their ability to pass on price rises. Increase in input costs, which is quite topical at the moment, or has been for the last kind of 18 months or so, with inflation being quite elevated. So this company has demonstrated the ability to do that and has continued to grow throughout that period. So this particular loan is a senior loan. It was low to moderate leverage, we'll call it, at 3.9 times. And it provides a very fat equity cushion for us of 65%. This is a 5-year deal and also benefits from having a leverage covenant. So this is a good example of a kind of deals that we're that we are structuring and arranging and originating for our portfolio. Moving on to the real estate debt market. Now, just a reminder to everybody that at Revolution, we do not do any construction or development loans. So what we're seeing here is we are seeing competition increase, but we're seeing it increasing in parts of the market that we don't really play in, being the kind of construction development, which is where a whole lot of new managers have come into the market. In the space that we play in, which is a kind of stabilized commercial property, industrial, office and retail, we are seeing the banks still holding on. We didn't think they would still be there at this point, but they are, and they're still funding deals at quite tight margins. So we see this pocket as being quite opportunistic for the fund. We haven't done very many transactions in the market, but we do keep an eye on it. We do keep our finger on the pulse, and we are actively looking. We are seeing a bit of an improvement in deal flow, and that's, I guess, a combination of what you're seeing out there with as rates have gone up, you're seeing cap rates kind of starting to widen and capital values start to soften, which is pushing up LVRs. And as loans are approaching maturity, they need to refinance these loans. We're starting to see some kind of interesting structures emerge, like AB notes, for example, or some deals that have higher leverage, which we're happy to look at. But we are mindful of the underlying dynamics in the market. Office is the first one that comes to mind. With working from home, which has been an ongoing feature of the office market for the last kind of, let's call it 4 or 5 years, which doesn't seem to be going away. So what we're seeing there is large corporates that took out leases pre-COVID, that those leases are now coming up for expiry. They're tending to kind of downsize their footprint, which is having an impact on the office market, not just in Australia, but globally. Heard some horror stories out of the US, particularly New York, as what's happening there. But we are mindful of that. And we do keep an eye on that. We also, very mindful of valuations. We often joke that getting, third-party valuations aren't worth the paper that they're written on, because, half the document is disclaimers. But we actually value every asset we do, and it typically comes in materially lower than the external valuation, and that is what we underwrite. So we are conscious of where we are in the cycle, and we do expect further softness going forward, but we are aware of that. The other thing we also consider is lease profile. As I mentioned earlier, with certain corporates that are downsizing their footprint, what does actual lease profile of these assets look like? And is it generating, or are these assets generating sufficient cash flow to pay and service the debt? So these are things that we're all keeping an eye on. I mean, broadly, pricing is maintained fairly flat. We're not seeing any real movements there, but hopefully that gives a good summary of what we're seeing in the real estate debt market. Next, we'll move on to the asset-backed securities market. So this is a market that's really driven by scale and relationships. You need to have scale and you need to have the relationships to successfully operate in this part of a market. On top of that, you need to have the skills and expertise in order to negotiate the key legal documents. And you also need to have the mandate to be able to sustain and have these kind of assets in the portfolio as they draw up over time. So those are kind of key features that not many people can support or can actually execute on. But in saying that, we have seen competition start to increase a bit. Some new players starting to come in, but they are facing those headwinds that I mentioned earlier. So it's not an easy job for them. Deal flow is increasing. So you've got the whole, non-banks are taking market share from banks. That's been ongoing now for quite a few years, and that's driven by global banking reforms. So you're seeing the growth in the non-banks. We're also seeing growth in current existing portfolio originators that are looking, raise new products and have new ideas and looking to grow. which is also creating deal flow for us. And we're also seeing non-existing kind of other originators that aren't in the portfolio, that are looking to grow and diversify their funding base, which is why they're coming to us. We can, we have the scale, we've got relationships, very deep knowledge and experience in the market, and we certainly have the mandate to execute on these. Pricing has been flat to probably slightly down, but nothing really material. We've seen public markets really rally quite strongly, where primary issuance has hit was reaching record levels. It's on track for a record year this year, and we've seen public market pricing come in materially. But in saying that, the illiquidity premium that we're seeing in the type of kind of private warehouses that we're doing still remain very strong in that kind of 250 to 350 basis points. So still very strong illiquidity premium, and quite a strong market for us.
So we said at the top of the webinar, how we believe we are different to many of our peers. So this particular slide, I wanted to cover off on the fact that we are very proud at Revolution Asset Management of the governance that we have, really at the philosophy level of when we established the firm. And so we wanted to highlight some of the key differences. I was saying to the team, I wish I had $1 for every time people said banks are getting out of certain areas, and then we're occupying those areas. We've got credit discipline. We offer a non-correlated income. Well, we say all of that, but how are we different? First and foremost, when we lend money, quite often it's not just the margin that we receive, but also upfront fees. The upfront fees is pursuant to that particular loan. We've had right from the inception of the firm. So the fees that we receive on every particular loan, right from the inception of the firm, have been passed to the fund in their entirety. There is no conflicts of interest here in us negotiating higher upfront fees because we get some or all of those particular fees. Moreover, there's this articles coming out in the press about the opaqueness of what's in your private debt manager's loan portfolio. We have a third-party valuation that happens every single month on every single loan. So there is third-party independent scrutiny on every single loan that we've made. It happens every time we accept capital, which is every month. Again, we welcome more scrutiny and more spotlight on this space, and it will really help to weed out some of the poorer operators in the space. We, as we've mentioned in the webinar, are across 3 separate and distinct areas of lending, which gives us a unique relative value approach for us to be able to construct portfolios with the lowest unit of risk to be able to provide the return that we promise. We, as we've shown in that example that Dave mentioned, are now being able to set the terms, conditions, covenants, and get better pricing, which aids our investors as we've grown in scale. We are a very well-experienced team that has been around for a long time and have got experience through the full cycle. And we are laser focused on the 4 to 6% margin part of the portfolio, credit margin above the floating rate. We don't barbell portfolios with low risk coupled with very high risk transactions. Why don't we do that? Because we don't have any performance fee objectives. We're not incentivized to do 15 to 20% margin loans because we still get paid the same management fee. So we haven't got an incentive to barbell portfolios or to reach for more yield than what we promise our investors. This is in fact a defensive capital stable product, which people can give up some liquidity to get a better return on their defensive part of their allocations. This is our historical performance for the wholesale feeder vehicle in Australia. You can see there the returns over time have benefited from the higher base rates through that period. We've got a yield, as we mentioned, 10.3%, credit margin of just north of 570 basis points over the floating rate. We've now got 57 loans in the wholesale fund because of some direct assets. Everything is floating rate with a fairly low credit duration given the seasoned nature of the loans in the portfolio. The total fund, when you include the wholesale feeder vehicle as well as a New Zealand pie, is now north of 2.5 billion Australian dollars, as we mentioned. wanted to turn it over to Phelan to host the questions and answer session.
Great, thank you, Bob, and thanks, David. Plenty of questions come through. There's a few you might be able to pick off. Early, you talked about yield to maturity on that previous slide. Explain why you use that versus running yield, or if you view them as
running yield for us is composed of both the margin and the upfront. So I mentioned we pass all the upfront fees. We amortize the upfront fees through the expected life of each loan. So the yield to maturity really captures both the margin and the upfront fees, and it's our best view of the next 12 months of what we can expect as a gross yield.
okay? Yeah, that's helpful. Who are the buyers of PIK? Or PIK?
Who are the providers of PIK?
Or
guys that issue PIK loans are typically, as I mentioned, the guys who are reaching for more risk and more return. If you think about what base rates have done, going from basically zero rates to currently in Australia 4.35% base rate, the kind of leverage that we're talking about in the margins that have been required by some of these offshore guys mean that these companies, right from the beginning of the loan, are unable to actually pay the interest because base rates are so high. So how do they solve that problem? Is to take some of the credit margin in cash and then have payment in kind or capitalized interest for the remaining part of the interest, which is almost admitting that these companies are over levered out of the gate and have less equity in those particular deals. As Dave mentioned, we don't really participate in that space. Everything we do is cash pay.
I might just add, just in relation to PIK, what happens when a loan starts picking is you start to see the debt increasing. So when times are good, it can work okay, right? Not ideal, but when times turn and companies start to suffer, they start to weaken, you've got your leverage increasing at the same time as EBITDA is coming down. Well, you've got your debt increasing while EBITDA is coming down. So your leverage is actually increasing, which eats into your equity buffer. So it doesn't always end well, and it's not something that we like at all.
Okay, well, we've got a few that we'll try and skip through reasonably quickly. On the case study you highlighted, was that a refi or a new deal?
That's a new deal.
Okay,
deal.
And we engage directly with the sponsor on that particular deal. So unlike other deals where there's an underwriting bank, the reason why we could actually set a lot of those terms and conditions and really shape that deal is because there was no underwriting bank in the middle, not to mention demand underwriting type fees, which benefited our clients.
Yep. And that was the total requirement was 125 million. Revolution provided 100 million of that. Is that correct?
There was also, in addition to the term facility, there was a requirement for a revolving facility, and there was one other private debt manager that provided some smaller piece of that deal.
Yep.
The total size of that deal was 180 million, of which Revolution provided 100 of.
Okay, and a couple quickly on asset-backed security. So can you provide an example of a recent asset-backed security deal? And then a follow-up question related to mortgage warehousing. So how the pricing works within that. So if your return target's 4 to 5% over the cash rate, who's paying that in mortgage rates?
Yeah,
that actually comes up quite a lot for me as well.
Okay, good.
In terms of understanding capital stack, etc.
We this is for our New Zealand audience. One of the more recent deals in asset-backed security was for ELNF in New Zealand, which is an equipment provider of debt against critical equipment in New Zealand. That was one example of a recent deal that we provided the mezzanine finance for, again, a private equity acquisition here in Australia for Anchorage. But really getting to the nub of how do we get paid, much more than what we can get in a mortgage deal. The science really comes from the fact that the structure of these deals in asset-backed securities, predominantly most of the funding is being provided by banks. It's perverse because non-bank lenders are now more in the space, but more than 90% of the funding in these asset-backed securities pools are being provided very efficiently by large banks, typically at the floating rate plus 150 to 160 over, sometimes even tighter than that. So if the bulk of the funding is at that tight level, the non-bank originator can actually pay and afford to pay people like us who are in the mezzanine side, which really sit above the equity piece that the non-bank originator puts in for alignment, at more like what our average yield is across the asset-backed securities portfolio, which is north of 6% over the base rate. So that is quite a very high risk-adjusted return for what we believe to be quite conservative credit, because it still is above that equity tranche. And prior to the regulations changing, banks used to be able to provide this more efficiently than people like us, but they've moved out into more AAA sort of part of the structure. But the alternative would then be that the non-bank originator would have to put in more equity, which is more expensive than what they pay us for that mezzanine. Hopefully that makes sense.
Yep, that makes sense. And then skipping on to the real estate debt, we've got a specific question. Can we just get a couple of comments on that market? So we're seeing some properties getting repossessed by non-bank lenders after cost blowouts, project delays, etc. I'm aware you guys don't invest in the space, but keen to get any additional thoughts on that market or problem areas that you might see.
Look, we've been very wary of this sector right from the beginning. We saw the complying developments in Australia, in New South Wales in particular, of self-certification of building, of high-rise residential towers in particular. That was one sort of red flag. The other one was in inflationary periods, as we've witnessed. This was not something that anybody had on their radar when we first started 6.5 years ago, because inflation and rates were next to zero. But we understand, because we've been through cycles, that should that sort of that sort of macroeconomic picture emerge, this is a sector that is very cyclical. So what we're seeing is insolvency rates are much higher than historical. So we're at decade highs in insolvency. And the vast majority of the sector that's represented in those insolvencies are builders and developers. They've been impacted by higher input costs, be it labour costs, interest rates, all of their raw material costs. All of that has meant delays. Delays mean time, and time equals money when it comes to completion and then ultimate sale. So a lot of the equity has been eroded because margins have been eroded, but then also some of these private debt managers who have played this game of taking money from clients and giving it to property developers, and hey presto, 12 months later you get a 12-15% return. That game is really up in terms of many of these projects.
Great, thanks. I'll try and get through a couple of other quick ones. There's been some suggestions in the industry that major banks are coming back into lending in recent months, like stepping up their exposure. Can you make any comment on how this might impact your activity or otherwise?
Look, we don't see major banks as being major competitors to what we do. The Basel reforms that we've seen were the catalyst of the growth of private debt markets globally. This happened more early in the US market because the European and US banks were in far worse shape than Aussie banks. We've seen the global banking reform impact the Australian banks really from 2016, then accelerating into 2018. If you think about the regulator, should there be another global financial crisis, the main aim of these banking reforms is to make banks more secure and those pillars of the economy stronger. We don't really see the thematic of the regulator easing off and letting these banks going back into areas that they've now effectively made them very prohibitive from a return on equity point of view. So we're certainly not seeing the return of banks into the areas that we're involved in.
Okay, two more, maybe three if we can fit it in. What proportion of your loan portfolio is written when interest rates were zero, and does that kind of create any concerns for you?
Okay, a lot of the loans were written early, but remember the philosophy of Revolution. It is companies that can really deal with higher input price shocks. So when we talk about a great example of this, when KKR first bought Arnott's Biscuits, rates were near zero. They've had to deal with the same inflationary effects as every company on earth. Higher input price shocks on rates, raw material costs, labor costs, freight costs, everything. What we've seen though, because we get regular information on this particular loan, we've seen the 35% gross margin really being sustained because they've been able to have the #1 market share, renegotiate all their prices up to maintain their gross margins and really pass on those input price shocks to the end consumer without any real resultant drop off in demand. These are the kind of companies and the resilience that we really model in every single loan, not just interest rates, but we really model on what happens should input prices go up for all the key drivers of these loans. And how would that company be able to respond? I can tell you now, if you're lending to a small company, an SME, they would not have the same ability to really have the same market power to put up their prices and not have demand fall off, and therefore their gross margins be contracted.
We do quite a lot of due diligence on every deal we do, and part of that, as Bob mentioned, is modeling what happened in a downside scenario. We don't just run one downside; we run multiple downsides, and we combine multiple downsides as well to see what happened if they all hit at the same time. And one of those things is interest rates. So even though rates may have been zero, we'll settle under no illusion that they're going to be there forever. So we definitely modelled, the impact of higher rates through the cycle.
Okay, thanks. Have you found significant competition with capital influx into the space? If so, how does that affect how you invest?
As we mentioned in the webinar, we've seen a lot of the international guys coming into the Australian market. They generally are targeting higher risk return, as we mentioned. Therefore, they're not direct competitors to what we're doing. Those deals are more stretched, more levered, and therefore not really in line with our philosophy. On the asset-backed security side, there are some newer entrants who have got to scale, but again, there's not more than half a dozen who are at scale. And when I talk about scale in Australia, I'm talking about $1 billion plus in deployed capital. So again, it's not like the US market where you've got literally hundreds of managers looking for the same deals. It's a bigger pool over there, but they're obviously a lot more competitive. In Australia, it's more in its earlier days and less scale players.
Okay. A nice easy one to finish. Any interest in starting a wholesale fund?
A wholesale fund? We do have a wholesale fund.
This is a wholesale fund, so it's a good easy one to finish on.
Right.
So
I thought that was a trick question.
No. Yeah. So there are a whole bunch of other questions. Sorry, we can't get to them all. But thank you to Bob and to David. Really good session today, and especially for all the huge amount of questions that came through. Apologies we couldn't get to them all. We will try to get back to everybody individually, and please reach out to your channel capital contact on the screen there if you want to come to us directly for a burning question you didn't get to submit. So thanks again to both of the presenters. Thank you all for dialing in, and enjoy the rest of your week.
Thank you very much, everybody.
Thank you.